Sometimes the financial markets decide to just tear up the textbook and throw it right out the window. That is exactly what's been happening lately, and honestly, it's like watching a real-time financial thriller. Everyone is scratching their heads trying to make sense of events that literally seem impossible together. So in today's Explainer, we're going to put on our detective hats and piece this massive puzzle together. We really need to understand exactly why the Fed is changing guidance. Porque la Fed cambia guidance, because it is absolutely crucial for figuring out what's actually happening beneath the surface of our markets.
Let's head straight to the scene of the crime, because we've got a glaring paradox right out of the gate. Normally, the textbook theory says that if a central bank is fighting inflation and decides to pause its interest rate hikes, the bond markets should just take a breath, right? They should stabilize. But look at what actually happened. The Fed pauses, and on that exact same afternoon, 30-year U.S. Treasury bond yields absolutely skyrocket. I mean, they instantly hit their highest levels since July 2007. So a lower probability of rate hikes somehow caused long-term rates to explode. Clearly, something here is not adding up.
Section 1, a mystery in the markets. Okay, let's dive into this and figure out how the Fed is steering things right now, or rather, how they've totally stopped steering things the way we're used to. Let's gather up our first set of clues from that infamous Federal Reserve meeting. Now, officially, the Fed did absolutely nothing. They just held official rates steady, keeping them right in that 3.50% to 3.75% range for the fifth meeting in a row. Sounds totally peaceful, right? But peek behind the curtain at the actual vote count. It was 9-3. Three major members from Cleveland, Minneapolis, and Dallas did not want a pause at all. They explicitly asked for a 25 basis point hike. We're talking about the highest level of internal dissent recorded at the Fed since way back in September 2016. So underneath that surface level calm, there was actually a huge fracture.
Section 2. Why the Fed is changing guidance. And this brings us right to our prime suspect for all this market chaos. We really need to zero in on exactly por qué the Fed cambia guidance, and it all comes down to the new Fed president, Kevin Warsh, and his very deliberate choice to completely dismantle a 20-year-old communication strategy.
Now, Warsh didn't just wake up one day and decide to do this out of laziness. He's actually following a very specific playbook based on an incredibly fascinating concept called Goodhart's law. In simple terms, it means that when a measure becomes a target, it stops being a good measure. To put that in plain English, trying to predict economic policy based on historical market reactions is super naive today. Why? Because if the Fed tells you exactly what data they're watching, financial operators just stop looking at the real economy. They just stare at the Fed's lips. So market prices stop reflecting reality, and they just become this weird mirror of whatever the central bank just announced.
So the crucial point here, and this is a fantastic metaphor Warsh dropped during his press conference, is that operators are learning to play the ball and not the referee. That single phrase officially marked the death of forward guidance. That whole system where for 15 years the central bank literally spoon-fed us its future moves, a system they originally tried to sell us as the ultimate peak of transparency. Let's break down the exact steps of this massive shift. The old way was forward guidance, where the market was guided hand in hand by the Fed. The new way, the Fed just stays silent. The market actually has to do its own homework and analyze the economic data itself. You might remember the famous economist Milton Friedman saying inflation is always and everywhere a monetary phenomenon. Well, Warsh essentially took those exact words, always and everywhere, and flipped them to say the central bank should not always and everywhere be the center of attention. They took the training wheels off the bike, and that's exactly how the Fed guides markets today. Section 3, the signals of the yield curve. Now, without the referee blowing the whistle every 5 seconds, where are we supposed to look? Well, this is where the yield curve suddenly steps up, transforming into our ultimate compass for the truth. So, I'm posing this question directly to you because, honestly, this is the exact trap almost every analyst fell into during those frantic hours after the meeting. With forward guidance gone, the bond market started sending what looked like totally contradictory signals. How on earth do we decode them without getting totally confused? And this brilliantly illustrates the disconnect. Look at the split here. On the short curve, 2-year yields actually dropped 4.23%. That part of the curve was doing exactly what you'd expect, pricing in the Fed's immediate pause. But then look at the long curve. 30-year yields jumped to 5.2%. Why? Because the long end of the curve doesn't care about tomorrow. It is pricing in the risk of much higher, much more uncertain inflation down the road. If you're going to lend someone money for 30 years in this crazy environment without the Fed's reassurance, you're going to demand a much higher premium. These are two totally different messages, and we can't afford to mix them up. Section 4. Why bond yields are rising. Following those signals brings us right to the root of our next big question. To understand why those long-term bond yields spiked with such ferocity, we need to introduce a really critical financial distinction that often gets completely ignored. Let's use Occam's razor here. Let's keep it incredibly simple. There is a massive difference between a nominal rate and a real rate. The nominal rate is literally just the exact percentage number printed on your bond. That's it. But the real rate, that's your true purchasing power. You calculate it by taking the nominal rate and subtracting expected inflation. So here is the key to our whole mystery. You can absolutely have nominal rates rocketing up while real rates are actually going down at the exact same time. It happens when inflation expectations are running even faster than the bond yields themselves. Now, what's really interesting about this next piece of evidence is this massive plunge, minus 23%. Think about the setup here. We were in the middle of a global conflict, oil was surging past $100 a barrel, and inflation touched 4.2%. By the textbook, that is a perfect energy shock. So gold, the ultimate safe haven, should have been hitting record highs, right? But instead, it crashed from its highs of $5,000 an ounce down to $4,050. It lost almost a quarter of its value right during an inflation spike. So how do we resolve this gold anomaly? Again, let's stick to the simplest explanation. Gold relies entirely on real rates. When those nominal yields start racing up faster than inflation expectations, the opportunity cost of holding an asset like gold, which doesn't pay you a coupon, doesn't pay any interest, it just becomes way too expensive. That is exactly why the famous safe haven totally collapsed right when everyone thought it would do the exact opposite. Section 5. Beyond forecasts. All of these American gears shifting, from the gold crash to the total inversion of the Fed's communication, they really open our eyes to a much broader reality about the very nature of the economic models we all rely on.
Let's rewind a bit to 1981. Cambridge economist Frank Hahn wrote a book called Money and Inflation, where he totally challenged Milton Friedman's simple views on monetary policy. Hahn proved this really crucial, revolutionary point. The so-called natural interest rate, that magical equilibrium point the economy is supposed to trend toward, it's not a fixed number. It's a moving target. It shifts right under our feet with every energy shock or global event. So trying to argue whether the Fed is lagging behind this natural rate is literally like trying to measure your distance from a target that is never standing still.
And if you want proof of how wild things are, just contrast the conceptual chaos in the US markets with the bizarre calm over in Europe. Over in the US, 30-year yields are hitting 19-year highs because of shifting Fed guidance and inflation fears. But meanwhile, the European Central Bank kept its deposit rate right at 2.25%, with the target for returning to its inflation goal now slipping all the way to 2028. And look at this, Italian 10-year BTP yields, which, let's be honest, are historically pretty volatile, just held steady at 3.96% with an 81 basis point spread. It's not because Italy is suddenly bulletproof. It's because global dynamics completely shifted the risk premium entirely elsewhere, concentrating it all on American uncertainty.
Which perfectly sets up our conclusion today. Frank Hahn left us with this absolutely brilliant metaphor. He said, "The theory that we have is the scaffolding, not the building." Economic models are just tools, guys. They aren't the absolute reality of the market. So when the builders at the Fed decide to rip down the certainties we're used to, that scaffolding wobbles. Old historical relationships completely break down, and the classic textbooks get thrown right out the window.
And that brings us to our final thought, the real lesson to take away from all this turbulence. The Fed isn't going to spoon-feed us the answers anymore. The old rules of cause and effect were just rewritten right in front of us. So the real question now is, with forward guidance dead and those easy institutional predictions totally gone, are you ready to stop watching the referee, rely on hard data, and actually start playing the ball? Think about that as you navigate your own analytical process. Thanks for diving into this explainer with me, and keep staying curious.